The term Fed pivot refers to a significant shift or change in the monetary policy stance of the U.S. Federal Reserve, the Fed. The Fed is the central banking system of the United States, responsible for conducting monetary policy to achieve its dual mandate of fostering maximum employment and maintaining stable prices, inflation. The pivot typically occurs when the Fed alters its approach to interest rates, asset purchases, or communication strategies in response to changes in economic conditions or shifts in its outlook for the economy. A Fed pivot can be a critical turning point that signals a departure from its previous policy trajectory. One common type of Fed pivot involves changes in the federal funds rate, which is the interest rate at which depository institutions, banks, lend reserve balances to other banks overnight on an uncollateralized basis. The federal funds rate serves as a key benchmark for short-term interest rates and plays a crucial role in influencing borrowing costs and overall economic activity. During an economic expansion, the Fed may gradually raise interest rates to prevent the economy from overheating and to keep inflation in check. This process is known as a rate hiking cycle. Conversely, during times of economic slowdown or recession, the Fed may reduce interest rates to stimulate borrowing and spending, encouraging economic growth. This is referred to as a rate-cutting cycle. A Fed pivot occurs when the central bank changes the direction of its interest rate policy. For example, if the Fed had been raising rates to combat inflationary pressures but later shifts to cutting rates to support economic growth, it would be considered a pivot. Another type of Fed pivot involves changes in the central bank's asset purchase programs, such as quantitative easing, QE. QE involves buying government bonds or other financial assets to inject money into the economy and lower long-term interest rates. A pivot in QE could involve increasing or decreasing the pace of asset purchases or announcing the start or end of the program, depending on the economic conditions and objectives. In addition to interest rates and asset purchases, the Fed's communication strategies can also experience a pivot. The central bank uses its statements, press conferences, and speeches by its officials to provide forward guidance and signal its future policy intentions. A change in the tone or messaging of these communications can have a significant impact on financial markets and investor expectations. The reasons for a Fed pivot can vary, including shifts in economic indicators, changes in inflation expectations, geopolitical events, or external economic factors. The central bank aims to be forward-looking and data-dependent in its decision-making, adjusting its policies to best support the overall health of the economy. In conclusion, a Fed pivot refers to a substantial change in the monetary policy approach of the U.S. Federal Reserve. This can involve alterations in interest rates, asset purchases, or communication strategies in response to evolving economic conditions. The Fed seeks to maintain its dual mandate of promoting maximum employment and stable prices, and its pivots are driven by its assessment of economic data and the outlook for the U.S. economy.